Would you invest in a bubble that you knew was inevitably going to burst? Would you buy a business that is fundamentally broken? Good evening. We are the University of Western Australia team, and today we'll be presenting our sell recommendation on Redbubble, an online marketplace for personalised print-on-demand products. The company is currently trading at $1.04 and has an enterprise value of $163.3 million. We have identified 3 key catalysts that we believe will cause the company to experience a D-rate in multiples over time. This includes increasing competition, changes to Google's algorithms, and the company's deteriorating business model. We have a target price of 83 cents per share, implying a downside of 20.1%. The way Redbubble's business model works is that artists submit their design to the Redbubble platform, customers shop from a range of products, and Redbubble works with production facilities to make and ship the product directly to the customer. Redbubble operates via a number of different product groups, including t-shirts, apparel, stationery, and accessories, and operate across various geographies, with the main ones being the United States, the UK, and Australia. So when it comes to Redbubble, the main industry to consider is e-commerce, which is expected to grow at a compound annual growth rate of more than 19% until 2019. Growth in e-commerce is primarily driven by the rising penetration of the internet and the shift to mobile. However, with the shift to mobile comes lower conversion rates, rising customer acquisition costs, and lower average order values, all of which have a detrimental effect on Redbubble's future profitability. At the same time, Redbubble continues to experience increasing pricing pressures as a result of surging competition. This is largely due to the highly competitive nature of the e-commerce industry, which is characterised by low brand loyalty, low customer switching costs, and many firms offering similar or identical products. If we take a look at the graph on the left, we can see that Redbubble is tiny relative to e-commerce peers with similar network effects. At the same time, Redbubble has already had to lower base prices of t-shirts by up to 20% to remain competitive against Amazon, and this has led to continuously declining average order values, which has fallen from over $53 in 2016 to under $45 in 2018. We are therefore of the view that even though Redbubble operates in a growing industry, their business model just simply isn't sustainable enough to benefit from it.
Thank you, Rachel. So Redbubble is experiencing extremely high competition, reducing their average order value. We also think that they have low brand loyalty, which means they are extremely reliant upon Google. Therefore, Google is Redbubble's landlord. Google consistently changes its search ranking algorithms in order to provide its users with the most relevant search results. Companies in the e-commerce business have been affected by this. Redbubble has been affected twice in the past year, in August and November, after Google changed their algorithms. They saw lower organic growth and traffic. In 2016, Redbubble saw 40% of their paid sources of revenue. We expect them to rise as the company has to spend more on marketing to combat this change in Google algorithms. So the change in Google algorithms sees less people clicking on Redbubble links as the links fall down below on Google's search results. What's even scarier is that similar companies in the e-commerce business have been affected massively in the past. Internet retailer Overstock saw a 25% decrease in their share price, and Cafe Press, an almost identical business model, saw their share price fall by 50%. We think that Redbubble's relationship with Google is extremely unhealthy. So management is also dealing with their own issues. EBITDA and growth target guidance are a big thing as they are still a young, high-growth company. Redbubble needs to achieve growth of 30 to 40% each year in order to achieve their profitability set by the market in FY19. Last year, however, they missed this growth target, achieving only 11% growth in their core business. They tried to cover this up with the acquisition of TeePublic. However, the market punished them. No wonder why Redbubble's management looks like a constant merry-go-round. Would you get off this high-growth supposed gravy train? Robin.
Thank you, Regan. Moving on to the customer side of the business, we have found that Redbubble has continually failed to make their customers profitable. This is mainly due to the uber competitive nature of the e-commerce space, which can be characterized by a high threat of substitutes, high bargaining power of customers, as well as high competitive rivalry. It's also reflected when we look at the progression of the customer acquisition costs, which have continuously been increasing, coupled with the declining one-year customer value. Essentially, what this tells us is that Redbubble's business model is fundamentally broken. Redbubble's only competitive advantage comes from their network effect. The value of network effect comes from critical mass and being able to offer a certain level of supply and demand needed to make a marketplace successful. However, a network effect only becomes a competitive advantage if there is significant brand loyalty. We have found very little brand loyalty, both on a customer side as well as on an artist side, with 55% of artists selling on multiple platforms and only 30% of customers making repeat purchases. Interestingly, management do not report monthly active users, which is a key benchmark statistic that is used within the e-commerce space to measure brand loyalty. Management have highlighted they simply do not track this statistic, but to us it tells us that they don't track it because they're too scared for what the results will say. Management have also shown their inability to drive brand loyalty, which you can see by the stagnation of the number of purchases per customer per year. And without improvements in brand loyalty, Redbubble's network effect and therefore their business model is unsustainable. This leaves them with one option: to cut costs. If you look at the waterfall chart, you can see that we've highlighted that 72% of all their costs are fixed. Whereas, as Regan mentioned earlier, we forecasted paid marketing expense as a percentage of revenue to increase. This only leaves operating leverage. We have already forecasted significant operating leverage, with OPEX to go from 23% of revenue in FY18 to 11% in FY24. Even with this significant operating leverage, Redbubble will not meet the level of profitability expected by the market without substantially cutting down on their growth investments. This leaves them in a very difficult position.
Thanks, Max. Moving on to our valuation. We valued Redbubble using the discounted cash flow method and the relative multiple valuation. Our analysis focused mainly on looking at what the company would look like as a mature entity and the investment the company would have to make to achieve its growth targets. Our financial forecasts were based off our expectations of customer growth, artist growth, and average order value. We also took into account the investments that the company would have to make through operating expenses and website development costs to achieve the company's goals. Going on to our DCF valuation, we valued Redbubble under 3 scenarios. For our central case, we were able to find an equity value of 77 cents, which was derived from a net present value of unlevered free cash flow of 9.94 million and a terminal value of 187 million. This represented a downside of 26.2% on the current share price. Looking at our relative multiple valuation, we valued Redbubble at $0.98. This was derived off our expectation that Redbubble will be able to achieve FY19 revenue of 247.24 million. We analyzed Redbubble's domestic peers and international peers and came up with the EV to revenue multiple of 0.9 times, and this gave us an enterprise value of 244 million. We weighted our DCF valuation 70% and our relative multiple valuation 30%, and this gave us a target price of 83 cents, representing a downside of 20.1%. The main risk to our investment thesis is rising brand loyalty and acquisition risk. Rising brand loyalty would lead to the business having lower marketing expenses and less website development costs. And acquisition risk is mainly due to the possibility of a larger e-commerce business acquiring Redbubble at a premium to its current share price.
Thank you, Tapua. To conclude, Redbubble will continue to be plagued by increasing competition in the uber competitive e-commerce space. And because of low brand loyalty, as well as low switching costs, Redbubble will be dependent on Google to drive customer growth. We've already seen the effect Google has had on similar businesses in the past in the e-commerce space, and Redbubble's deteriorating business model, reflected by guidance misses and low brand loyalty, means they're even more dependent on Google. Do you really want to invest in a company that is so highly dependent on another, One small change will cause the share price to drop 50% in a matter of weeks. We sure don't. So reiterate our sell rating on Redbubble. Thank you. We now open the floor to questions.
So, pretty compelling negative case. Why are other people buying the shares? What do they see that you guys don't see?
So, as you've seen in our analysis, Redbubble is growing its top line very well, but they are achieving this by paying for this growth through marketing expenses. So, the way other members of the market have looked at Redbubble is that they just look at the EV to sales multiple, and as long as Redbubble is able to achieve its growth targets, they're willing to pay for that growth. But from our analysis, when we took a look at the business economics, if Redbubble continues to pay for this growth through marketing expense, eventually Redbubble won't be able to be as profitable as the market expects, because the market is really expecting a high level of operating leverage based off expectations from other e-commerce businesses. But if Redbubble has high marketing expenses, this will filter down to the bottom line and Redbubble won't be as profitable as they expect. So that's where our thesis is different to the rest of the market.
I think the key issue comes down to, thank you, Tapila, but I think the key issue comes down to brand loyalty. Because of the low brand loyalty, the market expects brand loyalty to increase in the future, but with these e-commerce businesses, it's very much a hit or a miss. You either generate the brand loyalty, which takes obviously quite a bit of time, or you don't. And we've forecasted that Redbubble will not be able to generate the brand loyalty, which means they won't be able to be as profitable, because like Tapila said, they will be very dependent on their paid marketing and their paid customers, which we've already seen in the past, as Regan highlighted previously.
Another question on valuation again. So, EBITDA for Redbubble has been moving to positive territory from negative territory. So is there, can I know like at what EBITDA multiple they are trading versus peers? And any reason you haven't placed more weightage on EBITDA versus the DCF?
So the EV/EBITDA has been negative up until the last half year 19, where Redbubble acquired TeePublic, which kind of covers up the trend of the organic business. So that's probably to answer your second question, why we didn't look at EV/EBITDA as much. So that would rely on, then would have to forecast out what the EBITDA multiple is in the future. And then Redbubble as well, to its competitors, most of its competitors will be trading on an EV/EBITDA multiple of around 20 times. And we don't think Redbubble would trade on that multiple just due to its inferior business model, because as the market would tend to then appreciate the lower EV/EBITDA multiple EBITDA this company can generate, the multiple wouldn't be as high.
I'm looking at your page 13 slides. You give us the bear case, you give us the bull case, and the base case. When I look at this chart, I actually feel quite comfortable about the company, because in the bull case scenario, I can have 4 times return. And in bear case scenario, I only lose 15 or 50%. So how you explain it?
So our feeling is that the fundamental thesis of ours is the Google algorithms. So Google algorithms is almost like a black box. No one can really predict how they'll change. So Redbubble has had this repetitive problem with the Google algorithms. So we feel that in the next 12 months, no one can really tell what's going to happen with Google algorithms. The only thing that you can tell is that they are going to change. And Redbubble continues to have to invest again in marketing costs and website development costs just to keep up with the current growth rate. So even though we have this high case bull scenario, which is basically based on the EBITDA margin of companies that have been able to be successful, we don't believe that Redbubble will be successful due to this fundamental flaw in their business model because of their reliance on Google algorithms.
So to me, when I look at it, I think of asymmetric risk, because you constantly have the risk of Google algorithm changes. That's a risk that can happen tomorrow. I think last year there were around 27 Google algorithm changes. But we're saying for the upside case, there is an upside case if they can drive brand loyalty, but it takes a lot of time to develop this brand loyalty. We've seen Amazon is still not profitable because they're very much highly investing in trying to just keep retention rates really high for their customers and invest as much as they can to drive that brand loyalty. So that's our bull case. We're saying that if they drive brand loyalty, then you'll get that bull case. But that's an asymmetric risk, because Short term, there are many Google algorithm changes, but long term, there's the potential for brand loyalty to come through.
Yeah, but you do aware that Amazon is one of the most successful company in the world, right?
Yeah, definitely. And I mean, that's also because they've been able to drive brand loyalty. And their customers are very loyal through their loyalty programs. But we're saying Redbubble isn't able to do that. And we've seen that now where management haven't been able to drive brand loyalty. They've kept, I think the number of repeat purchases per customer is only 30% of customers make repeat purchases, which has stayed constant, even declined slightly. And the number of purchases per customer has declined as well.
Thank you.
Just on the cash flow going forward, why is it going up? I'm sorry, CapEx.
Okay, so so the reason why we forecasted CapEx will continue to rise is mainly due to, as the business generates more traffic, they have to continuously develop their website. It just doesn't stop, and like we said also, with the Google algorithm changes, the business constantly has to hire software engineers to develop the website and edit and make sure that it continues to work functionally and the website can still maintain the current traffic that it's getting from the revenue growth. So that's why we forecast the cash flow to continue increase. CapEx to continue increasing.
Okay.
In terms of business model, is the company planning on adding more products to the existing platform?
Last year we saw the acquisition of TeePublic, and this acquisition the market kind of viewed quite neutral. They did add quite a few products to their mix in terms of just different products, and they increased their fulfiller network with that acquisition.
We saw that the margin probably is on the decline trend because they incur a lot of marketing costs, but what is the EPS growth for the next 3 to 5 years?
So on an EPS level, we forecast profitability in FY20, so not this year but next year, which is different to the market because they forecast in FY19. But in terms of EPS growth, I guess I'll just quickly go to the valuation. If you look at the summary of financials, so we looked at the EBIT level because these businesses are either valued on EV to sales or EV to EBITDA. So we do forecast EBITDA improvement. That's mainly due to the operating leverage, but we're saying they're not going to hit the EBITDA expected by the market. But in terms of actual CAGR, I'm not 100% sure.
A general question. Do you think the e-commerce company should use DCF to evaluate?
I think for e-commerce, DCF is probably the best way to go because if you look at Redbubble, for example, they're quite young and they're growing very quickly. So a lot of their value will be in the terminal value. So that's why we chose to weight our DCF 70% and just the comps weight 30% because we think like a lot of their value does come at like the terminal level for Redbubble. And I think a lot of other e-commerce businesses are similar because they might not necessarily be profitable as well.
Your terminal value, I think on one of the slides says 190 million, but the terminal free cash flow is like 6 million. So that sounds a huge multiple of the terminal free cash flow. Just what are the inputs that give you 30 times free cash flow as the right multiple?
So I think that would be down to our expected perpetuity growth rate. So we use the higher expected perpetuity growth rate just due to how quickly the business is growing. So just to compensate for our lack of cash flows and the net present value, because the net present value only had 9 million of cash flows, so we wanted to compensate for that lack of cash flows. So that's why we had such a high multiple on our terminal value cash flows.
So what is your terminal growth rate? Sorry, I can't.
So we calculated our terminal growth rate based on the geographies that Redbubble operates in, based on the expected GDP growths. So it's averaged at 3%.
The main metrics you've used to measure loyalty, customer loyalty, has been the repeat customer rate, and you've compared it to Etsy. So question is, I've seen that Etsy is a much bigger company than Redbubble, and what's the trading business operation period for Etsy versus Redbubble? Because generally what happens is it takes time to build up the repeat customer numbers.
Yeah, definitely. But we looked at Etsy because There aren't many. There are no more public companies that do exactly the same thing as Redbubble. But Etsy is similar, except they don't sell. They don't sell kind of t-shirts. They sell more goods that people have in their house. But it's similar because it has a network effect. And the reason why Etsy is so valuable and so successful is because they've been able to build this network effect through their brand loyalty. They have much higher brand loyalty, and even though they're a lot bigger, they've gotten this big because from the start they were focusing on this brand loyalty.
That was the University of Western Australia with a cell on Redbubble. Now that the teams have finished, we will sequester the